You are live.
I'm live. Okay, so we had a little bit of technical errors here going on and getting us live. And thank you all for joining me. And hopefully, we're going to work through these on the back end with my guest. But he will be available momentarily. Anyway, thank you all for joining me for the Ellen Show. Am I allowed to be the Ellen Show now that Ellen is no longer on the air? I don't know if I'm allowed to say that or not, but that's what it is. I got my name honestly, so that's what I'm doing. Okay, we're gonna have a fantastic show tonight. Tonight we are going to be talking about the different types of loan products that you can use when you want to renovate a home. There are all kinds of different products. There are actually 6. I didn't realize there were 6. I was familiar with all these products, but I didn't realize there were 6 different ways that you could actually use if you're going to be doing a home renovation. It's actually pretty cool. All of them have different structures. You know, they have different terms of length, how long you can take out the loan for, different interest rates, different terms for payback, all of that sort of stuff. So we're going to go through all those different types of loans in just a few minutes. But first, I also wanted to say, check out my new video studio here. I'm really excited about it. Timothy actually put this together for me this week. It's that peel and stick wallpaper stuff that I got from Amazon. Have you all ever used that? Apparently, it is not the way to go. There's this guy on YouTube that Timothy was watching that even when he's doing the peel and stick wallpaper, he actually uses the paste because he says it's so much easier. I think it looks really cool. I'm super happy with the way that it turned out. Let me know what y'all think in the comments. I just love it. I can't be happier. And I'm also in my little hidey hole. So we did this in like a little walk-in closet that's off of my office. And I think it's so fun because I get to just hide out in here and do my videos. So, okay. So I've got a really special guest today. Brandon Kelly is a loan officer for Cross Country Mortgage. He is one of my preferred lenders. And there he showed up. He made it. Awesome. Good to see you, Brandon. Brandon is an engineer turned loan guy, which honestly, I think that is really cool because I love working with engineers because they always get things from the foundation. They understand how something works. They're not just pushing buttons and pushing you through a system that they don't really get. So when things go wrong, they don't know how to fix it. Brandon gets stuff. He's good at explaining things to clients, which is really cool. I really like that. Thanks so much for joining, Brandon. How are you doing tonight?
Good. Right now, I'm trying to figure out how to make this background as least distracting as possible, but things are good. This is a mirror behind me if it's not obvious, and so I spent the last 10 minutes trying to figure this out. But
it's all good.
Thanks for having me.
It's all good. Yeah, glad to have you. Okay, so we're going to be, somebody said they like my wallpaper. Joan says the wallpaper is nice. I love it. It's so newsy. I love doing all my little news bits, and it feels all newspapery to me. Okay, so first thing we're going to talk about is a HELOC. A HELOC is, everybody's heard that word. What's a HELOC?
Yeah, so a HELOC is a home equity line of credit. So essentially, it's only allowed on your primary residence, but it's when you are taking out a line of credit against the equity in your home. The benefit to a line of credit, say, versus other types of debt is that a HELOC has a rate that's similar to a mortgage. And I kind of, to your point, like to think of things in more of a big picture manner where most people, we talk about interest rates on mortgages being high, but mortgages have the lowest interest rates of any debt that you can get, really. And so, if you were to borrow a lot of money on a credit card, you'd be borrowing that in an APR around, say, 20%. You can get good credit cards at 18, sometimes even 12 with special deals. But as far as debt goes, a HELOC is when you're borrowing against the equity that's already in your home. The difference between, say, your mortgage and what your home is valued at. And so when you take out a HELOC, you have the ability essentially to draw on that, and you can use that as a line of credit, and you can do really whatever you want with that money.
So you said something a minute ago that a HELOC can only be used on your primary property. So I feel positive that I've heard people talking about using them, taking debt or taking credit out of secondary properties and using it to buy, purchase more investment properties or things like that. I guess they're just not using a HELOC. What might they be using in those kinds of cases?
A HELOC, I strictly do mortgages. We have some HELOC products. I don't specialize in them. I pass it along to
Gotcha.
people that do. But for the most part, general rule of thumb is that they're only allowed on primary residences.
Interesting. Okay.
Um, so you can take that money out. For instance, if you wanted to go purchase an investment property, a common tactic is you would, let's say your house is worth $400,000, your mortgage is at 200,000, and so you would have up to probably around about $180,000 that you can pull out of your house that you're borrowing on the HELOC and the line of credit, and you can use that to put that into an investment property. It's good for people that don't have cash on hand.
So, say I own an investment property and it needs some renovations. How would I finance that?
So it kind of, whenever I talk to my clients, it's really all on a personal basis in terms of like what we have to look at your financial picture. There's a lot of ways of doing that. So I guess the 6 different options that I can think of. Obviously, if you're going to borrow this money, you can do it on a credit card. You have the home equity line of credit. You have a secondary loan. You have essentially a secondary fixed loan. Um, you can do that really when you're purchasing through an FHA or a Fannie Mae conventional renovation loan. And then obviously you'd have to do cash otherwise. If you're going to do a small amount of repairs, and you're not able to do that in cash, you might consider doing that on a credit card. That's probably one of your easier options if you're working in the range of say $5,000 to $10,000. If you're going to go higher than that, you can consider a personal loan. So you can get a loan in a lot of cases up to about $75,000, in some cases unsecured, meaning that it's not actually tied to anything. These banks will, in some cases, be able to do that just on your credit without it tying to, say, when you get a car loan, it's tied to the car. A mortgage is obviously tied to the house. So you can do that through a personal loan if you're going that route. If you are working on an investment property, like I said, you'd have to use the HELOC, but there are options if you're going to purchase a property and it needs work, where you can essentially purchase the house and roll the costs of renovations into your mortgage when you purchase it.
Gotcha. Okay. So let me just recap what the HELOC is for guests who are just joining. So the HELOC is a home equity line of credit. It's generally is it generally a fixed rate? I don't know if you said that. Is it generally fixed for a HELOC?
HELOCs are typically not. No.
They're not fixed. Okay.
Yes. So they're the closed-end second loan is when you get a fixed loan on your home that's a second mortgage, and that is fixed.
And that is fixed.
HELOCs.
Okay. So, sorry, go ahead.
Sorry. So HELOCs the rate does vary with a HELOC.
Okay.
Sometimes month to month, sometimes quarterly.
So with a home equity line of credit, it works similar to like a credit card in that you can use some of it or all of it, or pay some back and then charge more to it. But it's a lower rate, and it also is tied to your home, whereas the credit card is unsecured. So it's secured by your
that's
home.
correct.
Yeah. Okay.
Yes, it's lower. Right. So a HELOC is lower than a credit card, but also has a rate that's higher than a mortgage typically.
Gotcha. How much higher than a mortgage is it usually? Average. I know it varies by person.
Yeah, in the range of about 1.5%, sometimes 2%.
Yeah.
So considerably higher.
Gotcha. What about the term on a HELOC? How long do you have before you need to pay it back?
So you have to make interest-only payments on a HELOC. So every month you're really just paying whatever the interest rate is on the balance that you've borrowed. There's one key point with that. There is no principal attached to that. So when you're making your payment on a HELOC, you're not actually paying down the balance unless you pay additionally.
Gotcha. But is there generally like a term that you have to have it paid off by, or is it just kind of like credit cards that can just kind of carry?
They may have a balloon at some point, say like 7 years, where eventually it becomes due.
Okay.
I'm not as much of an expert on HELOCs, just because typically I'll refer them to someone who does.
Sure. And for the audience, we're going to talk about these 6 different types of loans that you can get to renovate a home. But Brandon, primarily deals with mortgages, which we are going to talk. There's a couple different kinds of mortgages that you can use for renovating a home. We're going to talk about those, but these other ones are just, other options that we're throwing out there. Okay. So the next one is a home equity loan as opposed to a home equity line of credit. So what is the difference between the home equity loan and the home equity line of credit?
Yeah. So again, you'll typically hear these referred to as like a closed-end second mortgage, and you can actually get some loans. It's got a fixed rate. Some banks will actually give you a closed-end second mortgage at a lower rate than a HELOC in the range of a regular mortgage. This is kind of beneficial right now with where interest rates are. To give you an idea, I hate having to talk about it. Interest rates and where the economy's going have been. I've spent a lot more time talking about it than I really want to. I'm not an economist, but it has a large impact on what we do, and it has.
We're going to talk about it more tonight too, so get used to
it. Great. Okay. Perfect. Talk about it every day. So that has an impact on decision making. Just knowing where we expect interest rates to go. The short term, it's really hard to say. Long term, I just base my advice off of projections from experts. So the Mortgage Bankers Association, as well as Fannie Mae, came out with their projections for where they expect rates to go throughout the rest of this year into next year. They only made projections out through the end of 2024, so we can only see till the end of next year. But in their projections, interest rate is declining. Basically, it's supposed to decline throughout the rest of this year into next. We've had some, short-term bumps with this debt ceiling issue where, interest rate has kind of slowly crept a little bit higher, but we expect it to go down based on their projections. And so I say all that to say, HELOCs, when you're looking at, do I take out like a closed-end second mortgage or do I take out a HELOC? It really kind of comes back to how comfortable you are with rates and risk. If you think and expect, if you're trusting Fannie Mae, if you're trusting projections from people like the Mortgage Bankers Association, then a HELOC might work out in your favor because the rate changes with interest rates. So if rates continue to go down, your rate should go lower. So every month you would have a lower payment on that. The benefit to the closed-end second is that it stays fixed. And so if that's right now, if you could get a closed-end second that's percent or 1.5% lower than that HELOC, and it's fixed and the rates don't come down, well, in the long run that might turn out to be the better decision. But a HELOC, if you're feeling more comfortable with the interest rate environment declining, then it would make sense to stick with the HELOC.
Gotcha. So the home equity loan, it is fixed, but it's also paying back the principal. So the rate, so the payment is actually going to be higher as well, generally speaking.
It will
right?
be, yes.
Yeah.
And you are, but I guess the benefit, you are making a principal reduction with each payment.
Right. So if you're planning on paying it off short term anyway, that might be the sort of avenue you take, just because it doesn't matter that it's higher because you're planning on paying it off and you get the lower rate for the year or whatever. Okay. I want to, speaking of Mortgage News Daily, there was a graph that I saw today that I thought I would bring up. Timothy, can you bring up the housing starts graph? So I just found this a really interesting graph. Where did it go? There we go. I've got a thing. Oh, there we go. Okay. My mouse was over it. I couldn't see it. So this graph is basically, if you could scroll down just a little bit there so we can see. Okay, there we go. So the colors there are representing where builders are building throughout the country. So you can see that the yellow is out west, the green is the south, the Midwest is whatever color that is, teal or something, and then the darker blue is the Northeast. So like in the Northeast, they're not building anything and they haven't been for a long time, but you can see like over time from the 1960s, they used to build a lot more out in the Northeast than they are now. And now everything's happening in the South. I mean, the South is taking the brunt of all of this new construction that's happening throughout the country. There's another number graph down at the bottom that I'll show you in a minute, but we're outbuilding the rest of the country astronomically. I don't know 5 times what the rest of the country is doing. And I think it's really interesting because you can't see it in this graph, but it, I think this went along with air conditioning, like everybody up north was building, they ran out of land. But then, as air conditioning comes in, that's when you start seeing kind of the South picking up, because who can live in the South without air conditioning, right? But anyway, I just thought it was kind of interesting just where those different building products are taking place. And scroll down a little bit, Timothy. Let's look at that next graph. Okay, so this is the single family homes are blue compared to the 5 units are yellow. And if you look at that graph back to 1990, like how low the 5 units plus, so there's like apartments. So right there, look at how much lower it is for so many years. 20 plus years, they're building very few apartments, but astronomical amounts of single family homes. So this is like the period in time where everybody gets to buy a single family home, which, historically has just not been reasonable for the average person. But single family home construction is kind of dropping. I mean, we've been talking about in the news, you've been hearing about this, like how we're just really hurting for inventory. But really what's happening is they're building not just for just not single family homes, not as many single family homes, a lot more apartments. And we'll see in a later article that we're going to talk about that a lot of the single family homes are starting again to be bought up by builders. What do you know about this, Brandon?
Well, this is the first I've seen of this kind of information. I mean, anecdotally, I've definitely noticed it here in Raleigh. We're seeing a lot of apartments going up. I feel like there's just a lot of, more multifamily becoming popular, and just, less people going into homes. But I haven't seen data like that before. Mortgage News Daily is a great source. And I mean,
yeah,
it's certainly interesting to look at.
It just seems to me like people have this fear of wanting to buy right now because the rates are high and people aren't sure what's going to happen. But it just, to me, it's almost like potentially the last opportunity for many people, at certain income levels to actually be able to buy a single family home. I feel like that's kind of going away,
So yeah, so you mentioned it kind of jives my thinking on a report for Q1 that Mortgage Bankers Association put out on essentially the demand that's currently in place. There's a 30-year high or a 20-year high in the amount of people that would like to purchase within the next year, and are currently waiting. I see it every day. We have a huge, there's certainly the want there from buyers. There are so many people that really want to buy, but so many people are in a position maybe they can't, are just, I think for a lot of people, it's really more of, I don't want to buy right now.
I
And they're
agree.
scared of the high rates.
It's more, it's fear, and it's maybe not being able to afford exactly what they want. But I feel like as soon as rates come down, I feel like there's enough pent up demand that we're going to have another one of these like chaotic competitive markets. And just I bought as soon as things started to cool down, when things became less competitive. That's when I bought. And I just feel like, that's when you should buy anything, when people aren't fighting over it. People aren't, I mean, that's not true that people aren't. We're still seeing maybe 30% in places like Cary. About 30% of homes are getting multiple offers. So there are some bidding situations happening still, but it's so much less than it was. So it's a good time to buy, and people are afraid to. And what's his name? Says, buy
Warren
when
Buffett.
people are afraid. Yeah,
Yeah,
buy when people are afraid.
exactly
That's when
where
you're
it's going.
supposed to buy.
I like almost don't bring that up sometimes with my at the afraid of sounding like cliche with my customers. But look, I was just talking to, I happened to run into in a coffee shop today, an investor, somebody that I know well. We don't work together because he does a lot of flips and sometimes he holds, but it's not that common. For us, you have to hang on to the mortgage for at least 6 payments, or else we face penalties. So so we don't. There's not really an avenue for us to work together. But I was talking to him and was just picking his brain and asking how it was going. And I mean, I was almost surprised, although I probably shouldn't have been, to hear him say he was talking about it was a really good time to be buying and selling, contract flipping, and doing renos and flips, because he says a lot of people are afraid, which we're seeing. A lot of people are holding back from buying, and you can get good prices right
Yeah.
now.
Yeah. Timothy, bring up that number 2 article. I want to talk about that right now. This is actually really just timely, just based on what we were just talking about. So this is institutional investors are back in the housing market game, buying single family homes from 300 to 500,000. And that's, of course, the price that most people can actually afford to buy in. Large single family rental investors didn't have much of an appetite in the fourth quarter of 2022 and the first quarter of 2023, or perhaps I should say that they didn't have much to choose from. Purchases among single family rental operators were down 80% year over year, according to some estimates. And it wasn't because they couldn't make the rental prices work. The rental prices have remained strong. The reason is because there were fewer people selling homes and they didn't have anything to pick from, so they stopped buying. The slowdown in institutional investor single family rental purchases is temporary. That's not going to last. So-called Wall Street single family rental firms are back. Industry sources and housing number crunchers tell Housing Wire that institutional SFR firms that target $300,000 to $500,000 price point have been buying up more homes since March, just a couple months ago, with recent headlines including Pretium Partners' $1.5 billion purchase of 4,000 build for rent homes concentrated in the South and Southwest. So when we see like all of those people building homes in the South, there's a demand. There's a big demand here. And I think it's just, if investors want to buy homes, it's a good time to buy. You know what I mean? I just hate to see people waiting until interest rates go down, and then all of a sudden, bam, prices are going to go up, and you're going to be fighting and in the office today, I was in the Compass office and I was talking, or actually I was eavesdropping, and another agent was saying something about she had just received, they've just gotten under contract for her listing. And one of the offers that they did not take had $100,000 due diligence deposit, and they didn't accept that one. So,
Yikes.
Before that becomes the norm, that's not the norm yet, but before it becomes the norm, people need to get into the market. And before somebody says she's a realtor, she's drumming up business, I've told multiple people this week, it's not time to sell. So I don't just say something because I want the business. I say something because I believe it's true. Anyway.
Well, on that point, before we move on, yeah. So one common discussion that I've had lately, like the number I feel like people want to see is like mid fives. I think if you ask most people, if we get into mid fives, that's a rate that we've seen for a long time historically, and I think people are comfortable around mid fives. Well, okay, we're in the range of today. The average I want to say was about 6.8 to 6.9, and I just think okay, so the difference between a 5.5 or even a 5% rate and a 7% rate on, say, a $400,000 home, which is close to the median home price in Raleigh, you're talking about a difference. If the situation occurs that, and the projections from Fannie Mae, Mortgage Bankers Association, if they're accurate, and next year we get into that range, or even 2 years from now we're in that range, the difference in monthly payment is probably a couple $100 a month. You're probably going to make 15 to 20 or so of those payments. Overall, you probably will have spent additionally, say, $5,000 to $10,000 more than what you would have if rates were at mid fives, low fives right now for that same home. So versus if you wait, so many people are waiting. Competition is going to be so much higher. The price of that home in, a year and a half, a year, whatever, even a year from now, is probably going to be $20,000 higher on a $400,000 house. And so, that's just a 5% appreciation, which I think it'd probably be higher than that in Raleigh. I'm just speaking from Raleigh.
Of course.
So you're going to, again, you're only going to spend $5,000 to $10,000 more just out of pocket with a higher monthly payment versus then financing $20,000, even 10. If you finance that same amount of money over a 30-year loan, you're going to spend a lot more than $10,000. So I mean, by a comparison, perspective from where people are comfortable with, that's the conversation I have a lot. It's just that truthfully, if you move forward now instead of waiting, you're probably going to spend a lot less money, even
I
though
mean,
rates are higher.
the thing of it is we don't know what the future holds. It
True.
may be better, it may be worse. There's
True.
no way of knowing. And so not buying right now because you can't afford it is absolutely what you should do. If you can't
Right.
afford to buy because you're not financially set, you don't have some emergency funds to put aside, you don't have enough for your down payment, you don't have enough to make the mortgage payments, that sort of thing. Great. But if you're not buying because you think you're going to get a better time in the market, that's just bad because you don't know what's going to happen. So if there's a decrease in prices and you just bought a house, well, then in 3 years, it'll be different. You know what I mean? It's not like you're selling it next year. So what difference does it make if there's a decrease in prices if you're planning on living in the house? Well, one way that it could be a problem, and this is why I hate when people say date the rate. This drives me crazy. You don't. Now, yes, it's possible that you could refinance next year if everything stays the same and there's no decrease in prices, and there's no guarantee there won't be a decrease in prices. I think we've seen all of it, but there's no guarantee. But if you make a plan and stretch and say, okay, I can barely afford this mortgage payment, but I'm dating the rate, and I can handle it for a year, and then next year it'll be 5% and I can refinance. But wait a second, if prices do go down next year, well, if you're not planning on selling, it doesn't matter. But if you are planning on refinancing, it matters. You might not have the equity to refinance. You know what I mean? So I think that's something that people should take into consideration for sure.
Yeah, and again, and you do make a good point. Again, we don't know where rates are going, and I don't ever want to try and push somebody towards something they're not comfortable with. Certainly,
Yeah.
you don't know that they're going to come down, but again, I only base I can only go off of, and you're going to have to make a decision one way or another. I only base my decision making off of what we're seeing from these large institutions and what their projections are. And for other reasons, we see it in how they're pricing currently with their loans. But I mean, that's another story. That's a lot of information to get into there. But.
Okay, why don't we move on to our next way of financing? Where was I?
Figure out how to.
Okay, personal loans. We talked about a HELOC for people just coming on now. We talked about a HELOC, which is a home equity line of credit. We talked about a fixed home equity loan. Now we're going to talk about personal loans. What's a personal loan and how is that different from, let's say, a credit card?
Personal loans tend to have a lower rate than a credit card. It usually has more like a 5-year term. Interest rates are higher than mortgages typically. They sit probably about a few points higher, about 1.5 on just a personal loan. So again, they can be secured, unsecured, but they're typically a shorter term with a higher rate. So the difference is, I mean, if you're looking at taking out $30,000 and you don't have the means to do a HELOC or like say a closed-end second mortgage, then you may not have another option if you need, say, $30,000 worth of money to be able to do that with. You're probably not going to want to put that on a credit card. Well, certainly not. I mean, it's going to be a very high APR by comparison. So that might be a situation where you would utilize more of a personal loan. And there are banks that have, so they have home improvement loans where they're specifically for your home. They might have some better terms there. You have to use that money on your home, but you can also just go to a bank, say like a First Citizens, and you get a personal loan and just do whatever you want with the money.
Sure. Okay, those of you hopping on, feel free to drop your questions for Brandon about anything to do with lending. He would be glad to answer them for you. Okay, so personal loan, I wanted to ask too, is that harder to get financed for? So does it need a higher credit score since you're not securing it with anything?
I'd have to check and get back to you. Off the top of my head, I don't remember how they do qualifying for that.
Gotcha. Okay.
But yeah, I mean, you do have to do credit checks and that sort of thing, depending on the institution.
All right, cash out refinance. What cash out? Well, it's a refinance. Okay, can you explain the terms? How they differ from the other products we've talked about, interest rate and that sort of thing?
Sure. So for most people, this isn't a it's not something we're doing a lot of right now. There are people that this does apply to, though. So let's say you purchased your home 5 years ago. Again, you bought it at, we'll use the scenario of it's a $400,000 home. Home's worth 400,000 now. Your mortgage only has a balance of 200,000. In that scenario, there's about $200,000 worth of equity in your property. A cash out refinance allows you to potentially take a new mortgage on the home for the amount to pay off your existing mortgage plus whatever money you want to withdraw from the home, whatever equity you want to withdraw from your home. You can only withdraw up to 80% of the value of your home. So that loan could only be 80% of 400,000, which is, what's that, 320,000.
You're
So
the engineer. I don't know.
trying to do math off the top of my head. Could be wrong.
It's not easy when
Um,
you're on live too.
yeah. It's a lot easier one on one. But
Yeah.
let's just say that's the case in this case. So you'd be able to withdraw again up to 80% of the value of your home minus the mortgage. In that instance, I'm just going to do the quick math on my phone. So 400,000, 80% of that is 320, like I said. So if you had a $200,000 balance on your mortgage, you could withdraw $120,000 in cash in that scenario. A lot of people aren't going to do this right now because a lot of people refinance back in 2021 and 2022. So they have mortgages in the range of 2 and 3%. Some people, however, we are seeing, I know you had some data to the contrary. I had some data that suggested that, we're seeing a lot more debt. So some people might find themselves in a hole, in a bad position with credit card debt. It still does make sense for certain people if you have, if you're essentially leveraged with debt that has a high APR, whether that's through, I mean, it could be through a HELOC that's, just gotten out of control. You might have taken a HELOC, 2 years ago and never paid it off. And now, the balance on that keeps going up. I guess still in that case, it wouldn't make a ton of sense. It's really for those people that, whether it's
Those people
medical
go into the
or credit
mall and
card,
shopping too much.
yeah,
Credit
that then
cards.
you're starting to accrue just crazy APR in that debt. You might consider, or for any other special situation that you need cash now, you might still consider doing a
Yeah.
cash out refinance.
Yeah, I mean, there's a lot of people with inflation the way it's been, and food costs and basic necessities going up that are on fixed budgets. Retired people might be in this situation. You have a fixed
Right.
income. There's nothing you can do about it. And when food goes up that much, well, you're sitting on all of your equity in your house. It might make sense to pay 7%. As opposed and take some of that cash off and live off of it. It's, not ideal, but I could see where in some cases it would make sense.
Yeah, and again, some people may need for certain situations. Maybe you have some special situation that you need, say, $30,000 to $50,000. I mean, there are people that are in a
Right.
position they may need to get that. And honestly, again, mortgage rates are still lower than any other kind of debt that you can get, really. So
Right.
it's a good option potentially for them.
Yeah. Not for a renovation unless it's like, something mold or something that has to be done. But not for a typical renovation, I wouldn't think. All right. So a couple more options. Credit card, obviously, that seems kind of self-explanatory. You can use a credit card if
Hmm.
probably if something's more short term, and maybe less expensive, and you feel like you can pay it off over 3 or 4 months. Or sometimes people have 0% interest credit cards for a term,
Right.
6 or 12 months, and that's easy cash to use. You don't have to apply for anything. It's already there. Well, I'm going to, put in a new bathroom. I don't know if people keep that much credit on a credit card, but that would probably be a good idea if you had one of those short-term 0% rates. Do you know if I don't even keep up with that stuff? Is there stuff like that around right now? 0% rates on credit cards?
Yeah, I mean, I had one.
Oh, did
And
you?
it was a year long term. So,
Are you a
But
credit card game player? Do you like get
no,
points? I don't
no,
either. I can't keep up with it.
no.
I had a Loft card was the last credit card I had like 5 years ago. I do have I do have actually two credit cards, but I don't really use them. But I had a Loft card and it got lost under a pile of papers on I used it. I always paid off the balance. It wasn't like I was racking stuff up. Left it on my desk and it got lost in a pile of mail, and I paid it like a week late or something, and it dinged my credit. I was like, are you kidding me? Forget it. I'm never shopping there again, and you can have your credit card. And that was like, I was like, yeah.
So I'll tell you a funny story about that 0% APR card that I had. I learned two hard lessons with it. One was that despite having a 0% APR, they're not charging you any interest on the balance you have. You're still required to make minimum payments on it.
Right.
I didn't realize that. I think I was in my early 20s at the time, so I
Nobody tells you
let
this stuff.
up until 2 or 3 payments went by, and I figured out that I was supposed to be making payments. That was my first mistake. And then the second mistake that I made was after I found out that it wasn't truly like that. Um, I got upset and I was like, well, I don't even want this thing. And I closed the credit card, which is the second mistake I made. So I didn't know this. And I don't think very many people do that. If you are not using a credit card and you close it, or if you just have derogatory problems on the card, it makes more sense to hang on to the card, cut the card physically in pieces, put it in a place you're not going to use it, don't touch it, don't use it, and just leave the line of credit open. That is viewed more positively with credit bureaus because essentially
It's a racket. It's such a racket.
the way they look at it is that you have the willpower to not use the credit, but it will hurt you if you close a credit card. It actually hurts your credit.
But the other side of that is the credit card companies will close your account if you don't use it. So you kind of need to. I've had that happen to me before. It's a card that was just sitting there that I was never using. So you should use it once every 6 months or something like that. Buy something small, pay it off or whatever, just so it doesn't. I don't know if probably all credit card companies don't do that, but I know at least one does because that's happened to me, and it did make my credit. It did, ding my credit for a little while. Just I think because the percents are then off, like how much. Or the age of your account. Oh, I think it was an age of accounts. It was like a 10-year-old card or something like that.
Okay,
And it just got closed. And I don't remember the situation, but anyway, so yeah. So credit's such a racket because you got to pay attention to it. You've actually got to pay attention and make sure there's nothing happening. Make sure nobody's, nobody's scammed you or whatever. And also you got to kind of, it takes maintaining, like, buying something every once in a while or whatever. So I don't know.
I found out recently that if you don't use credit, even if you have very good credit, after a long enough period of time, you don't have credit anymore. And
Really?
that happened I had a client he really didn't want me to pull his credit. And so he had really good income, really good assets. There's no reason to think he didn't even have any debt. And so he's like, I don't have debt. I know it's really good. And I was like, okay. Right before he wanted to put the offer in, I went and I pulled his credit, and he actually didn't have any because he hadn't used it in so long. So
was he a Dave Ramsey guy?
It almost seemed like it. I didn't quite ask him at that point because we had to figure out what we were going to do. We got it done. We figured out a way to essentially get him the property. But yeah, no, it was an interesting situation. Hadn't run into that before.
All right. So last and kind of the best, probably what everybody really wants to hear about are the home renovation mortgages. There's actually a couple different kinds you were telling me earlier, which I didn't realize there was more than one. I thought there was just one. So tell me about those. What are they? How do they work?
Yeah, there's so many. I've got a cheat sheet. The most popular one everybody hears about is the FHA 203K. I don't really know why that's as popular as it is because it doesn't have, by comparison, to say Fannie Mae's Homestyle Renovation or Homestyle Renovation or Homestyle Energy. Freddie Mac has Choice Renovation. The USDA and VA both have renovation loan programs. I don't really know why everybody seems to know about the FHA 203K, but each each bank essentially has their own program for doing that. So I guess kind of to start from the top. So So a renovation loan, it allows you to purchase a home, let's say at $200,000, and essentially include the cost of construction as part of your mortgage. So part of your 30-year mortgage. So if you say bought a house for $200,000, wanted to do $100,000 worth of work to it, you would have after it's all said and done, you'd have a $300,000 mortgage, and the bank would fund the repairs, and essentially just make that part of your mortgage. Um, so each of these banks has their own program for that. Um, there's a lot of different pieces to it. There's a lot of, I guess I'll start with what questions you have prepared, Ellen, because there's so much I could go into with
Sure.
this.
Okay. So tell me the difference between the 203K and the Fannie Mae home style. Are there like pricing limitations? Like how expensive can the property be?
Yes. So the FHA has lower loan limits, so you wouldn't be able. They have. Well, I guess to first explain, conventional banks have better terms. Typically, they have lower rates, but the FHA is more lenient with issues with credit. They allow you to have a higher debt ratio than the
Mm,
conventional banks
okay.
do. And but the difference is, so the FHA's loan limit is lower, where the conventional banks can actually go higher than they can.
What are the loan
And
limits for the FHA and for the conventional?
yeah, so FHA's loan limit, I want to say, is 471 in Wake County. Conventionals is 748 200. And so essentially, again, that's the price of the home plus the repairs
What
in
about
in
down
those
payments?
cases.
Do you need does FHA just require the 3.5% down payment like with the
That's
regular
correct.
FHA? Okay.
hmm So, yep, that allows you to go to 3.5% versus Fannie Mae. You have to go 5%. So you can go with less money down. A first-time home buyer actually with Fannie Mae can go as high as 97%. So you can only go 3% down. Again, the qualifying, um, it's a little bit higher for Fannie Mae than it is for FHA.
Okay. What about interest rates for the two different products?
The rates right now. So one thing to consider with the FHA is the FHA has actually upfront um, mortgage insurance, essentially.
Right.
So there's a upfront mortgage insurance premium. Um, that's usually, I want to say, in the range of $5,000 or $6,000. The rate is lower, but then you also have PMI on top of that. So you have monthly
Oh,
PMI
wow.
on an FHA, any FHA loan. That PMI sticks around, so it's always
So
going to
that
be there.
so that $5,000 to $6,000 mortgage insurance is paid at closing. So it's a lump sum and then PMI payments.
That's correct. Yeah.
Wow.
So people kind of fail to realize that, and that sticks with the loan. So, a lot of people just look at rates, and that's kind of the problem with rate shopping right now is that,
Mm.
you could go with an FHA loan. The rate is going to be lower. The payment, in some cases, might even be lower, but you wind up financing more money. And so the upfront, again, that upfront mortgage insurance premium is yeah, paid at closing. Well, I should say at closing it's rolled into the balance of your loan, and typically financed. So
Oh, okay. So it's fine. So you have two different insurances
mhm.
that you finance: the PMI and the pre PMI premium, mortgage insurance
But
premium,
it's upfront.
basically.
Yeah, no, it's the same. Yeah, it's the same, but they do require it upfront with a with
Oh,
FHA.
gotcha. Okay. All
Yeah, yeah.
right. All right. Do you find that it's difficult or particularly difficult to find um, contractors that are willing to work with these types of loans? And I mean, do you know anything about that? I wanted to have Liam on. Liam is my buyer's agent, and he was a home flipper and has flipped hundreds of homes. He's like a wealth of resources about this stuff. But he wasn't able to make it.
I would think, for a contractor, it might be a little skewed here, because there's so much work to be done, and these GCs have a lot of business that maybe they can lean on. I would still think it would be a big benefit to a general contractor to do this type of work because it's essentially guaranteed through the bank. They don't have to, it's a sizable project. It's funded through the bank, not through a customer. You don't have to worry about, getting paid. there is a process with, I guess part of the downside to any of these renovation loans that makes it a little more difficult in competitive markets, especially in the last 2 years. We didn't see a lot of this because it requires a 45 to 60-day close in most cases.
Ah,
And so when things were really competitive and you had, in the Raleigh market, we were in a scenario last year where we were seeing 30 to 50 offers on a property. I mean, that was not uncommon, and that's not a stretch to say. There was a insane amount of offers with every decent property you saw. So it made it
yeah.
very difficult to come in with, 45 to 60-day offer. Most buyers had only hours to make offers. And that makes it even further, even that much more difficult for someone that has to go in. If you're making an offer with a renovation loan, like you have to come in, you have to figure out what you're going to buy it for, what you think you have.
It's a lot of numbers that are being tossed around through that whole
Yeah,
process. It's really challenging. Yeah.
right. So that's why, it would be really hard unless you had really good construction knowledge for like what it was going to cost. When it's a busy market, it's tough. Now that things have slowed down, there's definitely opportunity to do this type of loan in this market. If it picks back up, maybe not, but for now, that's the benefit of this type of market.
I had a buyer once who used a renovation loan, and they purchased a 1920s property. Get this, it had already been completely renovated, and it was beautiful. It was beautiful, but the contractor that did the renovations didn't pull permits, which we knew
Oof.
about. We knew it, and they wanted. I mean, loved the house. And so we had a really hard time. Like they wanted to get it permitted after the fact, and they just wanted to make sure that it had permits. So we had a really hard time getting the renovation loan because, or not the loan, getting a contractor because the contractors, a couple of them weren't really willing to bid when they couldn't get behind the walls. They didn't needed to see, and for good reason. This is actually funny how it turned out. So we had some contractors that wouldn't bid, and we finally got one that was willing to do it. And he did kind of spot checking no, we weren't allowed to do that until after. This is a couple of years ago, so I'm going back here. But anyway, he bid it, but then it ended up, not only was the couple things we knew weren't permitted, was the plumbing, and I think it was the electrical, if I'm remembering correctly. But the other thing that had been covered up that we didn't know about was the foundation. So he replaced the floors, like he gutted the place. And a friend of mine had actually walked through the property when it was empty, when it was gutted. Like he's like, he like loved, he was actually an engineer and he knew the home and had walked through it. He's like, they were down to the studs. They ran out of money and didn't actually complete all the foundation work, which of course you do not find until it wasn't something that was accessible that you could see from the crawl space or whatever. It was like up underneath the floorboards, but at any rate, they found that out afterwards. And so the whole cost was much higher than it ended up being, or than it ended up being bid for. That was kind of a hard one.
You drive my thinking on a really unique scenario that like this may have, depending on how all the repairs and what was required with that project. So one thing that's unique that we have done a couple times that might make sense is some people, what they were doing in that market when it was really busy. I did have some clients that purchased with just a regular loan, a conventional loan. Once you make 6 to 8 payments, they needed time anyway to figure out what they wanted to do. But you can actually do a renovation loan as a refinance. And so, yeah.
That's
So
a great
9 months,
idea.
yeah. So 9 months down the road, they bought the house, figured out what they wanted to do. They lived in it. They needed time to figure out exactly how they were going to do it. And then 9 months later, they got a loan with a refinance for, the renovations on top of, what they had purchased it for. So
That's a great idea. Okay, if anybody watching has questions, now's the time to ask because we're going to be wrapping up in just a few minutes. But before we do, I wanted to share one more resource for renovating your home that I totally forgot. I don't know why this completely blew my mind, but Compass Concierge. Are you familiar with Compass Concierge?
I'm not.
So Compass Concierge is through my brokerage, Compass, and it's only for people that are selling their homes, and you have to be selling with a Compass agent. But you can literally borrow up to $25,000 in the Raleigh area for free, no fees, no interest, nothing. if you're selling your home and you're listing with a Compass agent. It's a credit card, and you get it. You don't even have to use it for renovations. You can use it for staging. You can use it for, packing your stuff up and storing it. It's actually the most incredible thing I've ever heard of. But if you want to renovate something or do some kind of repairs or paint or fresh carpet or fresh flooring or whatever that just makes the house sell for more, the return on those kinds of things can be, triple in many cases. You spend $5,000 on floors and you can get $15,000 in the price of the house, but people don't do it because a lot of times they don't actually have the cash. And you can't generally do a HELOC. I know sometimes you can kind of get away with it, but you can't really do a HELOC if you're getting ready to sell, like they won't do it or whatever. So Blueface says, I'm just praying for this housing market to crash. A lot of people are praying for the housing market to crash. I get it. Well, thanks for joining us. Appreciate you being here. Anyway, all right. What else you got for me, Brandon? Anything else to add to the conversation before we sign off?
I'm trying to think if there's anything really to add on the side of these renovation loans. Again, I don't want to suggest this type of market is a good market for these types of products. They were more challenging during a busy market, and I think if things pick back up, then it would probably be difficult as well. That's when these creative solutions where that's when it might make sense again to, hey, you purchase 9 months down the road, you do the refinance and do the construction loan. Then, I mean, not a lot of people have, regardless of your price point, not a lot of people have, say, $150,000, in some cases $200,000 to put into renovating a home. But it would be a really good option if you've got a contractor you're working with and you're familiar with what is going to drive up the value. Then it could be a really good option for you in that market.
Yeah, I mean, you've got to realize too that there's nothing more satisfying than actually renovating a home. I mean, we don't have enough inventory coming on the market. So taking something old and worn down and turning it into something beautiful and making places, like when you renovate like entire neighborhoods where people come in and take like rundown houses, old 1960s, 70s, which is funny when people from up north hear that, they're like, old 1960s, 70s. But it's just such a beautiful process to actually see some. We renovated our last house, and it just, I don't know, there's just something about, and you always feel connected to it. My husband and I have always said that, like, you don't really own a home until you've done some renovations. You know what I mean? It makes it yours or something. Okay, we got some questions. And now that I've been through all my material, we've had now everything. I'm gonna have to start doing these at 8:00 instead of 7:00 because everybody's popping on now. How's the housing market with you guys? It's still really high here in Reno, Nevada. I'm a plumbing contractor. It's still pretty busy here. I was saying earlier, about 30% of houses in like the Cary Apex area are getting multiple offers. I'm trying to pull this data off the top of my head. I've actually got a video coming out next week. I'm working on all the data right now for it, which is a housing market update. So the places that have had increases are Cary, Apex, off the top of my head, I cannot remember. I think Nightdale and I think Zebulon are the towns that have had that are still up over last year and over last month. And then there's a few others that have had decreases in value. So off the top of my head, I know Wake Forest had a decrease. I think Morrisville had a decrease, which is unusual because it's kind of up in the more populated area. And I honestly can't remember off the top. I mean, anecdotally, things are still fairly busy, but it's really good to look at that data to get a good picture. But definitely watch my video next week. It's almost done. It's still in production, but you'll get some good answers to that. Anybody else? Sorry, go ahead.
You had put out some good information in your video. I want to say it was last week about. I most all of my clients are in the Raleigh market, but you had put out the video and talking about how I think it's only 20% of residents are, when they're looking to move, are considering moving from Raleigh.
That's right. 20. So that's actually, so the national average is that, and this is data from Redfin. So the national average is that 25% of most cities, or national average is of people that are looking for a house online are looking in a different city than where they currently live. So 25% of people on average across the country are looking to relocate to a new city. In Raleigh, it's 20%. And actually North Carolina, all of our cities, with the exception of Asheville, all of our cities are in kind of that green area with the kind of having the least number of people leaving. Most people come to North Carolina and they want to stay here. It's just a really nice place to live, whether you're in Raleigh, Greensboro, Charlotte, whatever. So yeah. So the housing market is still doing pretty well here. I think throughout the South, I had one more graph. What was that? No, I think we already pulled that up. But I think throughout the South that the market is still pretty good throughout the South. We're actually getting houses built, like, whereas in other places they don't actually have construction, like they're not building for whatever reason. So I kind of anticipate the South continuing to be a good market for some time. Yeah. Brandon?
Well, no, I always say, people here, and I think this probably applies to other cities in North Carolina, like it's a really good place to live, not always a great place to visit. We kind of complain about the fact, like, you're locally in Raleigh, there's not like a ton of attractions or a big pull. You don't say, oh, you have to go do X when you're in Raleigh. We kind of lack that. But other than that, it's just got a really good. There's high median income. You got the beach, you've got the mountains. You can go to a lot of places easily. Our airport is fairly,
I love our
good amount of
airport.
destinations. Yeah, that you can go. You can get in and out real quick. So a
It's
lot of
in and
people
out.
really
It's
like
pretty.
living.
Yeah.
Yeah,
So
a lot of people like to live here, but go
it's
ahead.
interesting that you say that. So I'm releasing a video tomorrow. It's a Charlotte versus Raleigh video. And so that's the big camaraderie here. Like Charlotte, everybody's like, that's where all the attractions are. They've got NFL teams. They got all the different, major sports teams. They've got Carowinds. They've got they got like 3 water parks, the Whitewater Center out there. And so everybody, all Charlotte people think that Charlotte is so much better because of that. But I dug through a lot of data and uncovered kind of one of the differences is that Raleigh invests a lot of money into our community centers and parks. And so Raleigh has a lot more parks and rec, classes, and local things that you can do that are more like community oriented. And the Charlotte Motor Speedway, Dylan says, but Charlotte doesn't have so there was actually data that I was able to find that showed like the number of parks and community centers and things per person or whatever. And it's just like half of what it is here in Raleigh. And the other thing about Charlotte is, I don't know if it's because of all of those kind of vacation style attractions, but they have a lot more traffic than we do. And it's not like it's that, it is more dense. The population's more dense. But for whatever reason, they do have a lot more traffic. And so, there's stuff that you give up for getting those kinds of amenities. And personally, I don't know, I lived in Florida. I spent half my life in Florida, and I never went to the beach. You know what I mean? I mean, how many people actually go to the Charlotte? Oh, well, the Charlotte Motor Speedway people might go to more frequently. I don't know. That's probably like a hobby thing. And I guess sports, or I'm just not sporty. Are you sporty? You are. You look sporty. No.
I played a lot of sports, and then I don't know why. I don't really watch sports a whole lot anymore. I got sported out. Yeah, actually, I'm a UConn fan, and because I grew up in Connecticut, and the UConn men's just won the national championship in March, and it was kind of a testament to where I'm at with sports, because it was nice, but I really didn't care. My team actually won the championship, and it really didn't move the needle. So I've kind of gotten burnt out on sports at this point for whatever reason.
The testament to where I am with sports is that I don't know what a UConn is.
Okay. University of Connecticut. Yeah, the Huskies.
But what sport is it?
Basketball team.
Basketball.
No, so that was men's basketball. Yeah.
Gotcha.
So,
a ball being thrown somewhere. Yeah.
Sure. I at least used to watch a lot more, but not. I guess I don't know why. So.
All right. Well, I hate to leave when the party's just started, but I did not bring enough material to kind of go on with anything, and I apologize for that. Next live, I will definitely make sure I've got at least 10 or 15 different news topics to talk about. But I appreciate y'all coming out, and thank you, Brandon, for being here. I hope everybody has, absolutely. Hope everybody has a great evening, and good night.
Thanks, guys.